The best way to earn cash in crypto is collecting fees when other people trade. It's called a liquidity pool, and if you provide the liquidity, you earn the fees. You can earn as much as 5, 6, even 10% per month. I've been doing this about 5 years, and my monthly average is 10%. That's per month, not per year. Most people don't believe it's possible, but in this video, I'm going to show you exactly how to do it. Try it out and see what you can earn. Borrow low, earn high. That's our DeFi carry trade where we turn our Bitcoin and ETH into daily cash flow. In the last video, I showed you how to borrow on Aave. Link is in the description. This time, we're going to show you the earn side, providing liquidity on Uniswap. You'll learn how to choose the right tokens, set up your price range, find the best pool, and open a position that generates cash every single day. Start with a small test position. $100 is perfect. It's just a proof of concept, right? Open the position and set an alarm for 24 hours. Come back the next day, check your fees, and do the math. You'll be able to calculate exactly what you earned in one day, then just multiply by 30 to get your monthly amount. Once you see it for yourself, you can't unsee it. Please just do me a favor and post your yield in the comments below. Now, before I show you the steps, there's one thing you must understand, and this is something that confuses almost everyone. When you provide liquidity on Uniswap, your position is doing the opposite of what traders are doing. If traders are buying, your position is selling. If traders are selling, your position is buying. What happens depends on what the traders decide, not what you decide. Think of it like this. Imagine you open up a little corner store and inside you only have 2 shelves. On one shelf you have token A and the other token B. Traders are going to come into your store and swap one token for the other. If a trader wants to buy token A, they're going to give you some token B. That goes on your B shelf and you're going to pay them with token A from your A shelf. If a trader wants to sell token A, they'll give that to you and you're going to pay them in token B. Now, of course, all of this is handled by a smart contract, but this is what happens when traders swap one token for another on a decentralized exchange. As a liquidity provider, your position takes the opposite side of every swap. Now, if the trading becomes very one-sided, your position can run out of one of the 2 tokens. For example, if traders are mostly buying token A, your A shelf is going to run out and your B shelf is going to fill up. In other words, your liquidity position can get fully converted into one of the 2 tokens. So the most important question is, am I comfortable holding either one of these 2 tokens? That's what we have to think about when we're deciding which 2 tokens to provide. Now, unfortunately, there are thousands of tokens to choose from. So what I'm going to do is just show you the one that I prefer to use, and I'll explain why this pair is really the backbone of our DeFi carry trade. My favorite pair is ETH and USDC. And the main reason is I'm just a really big believer in Ethereum. The entire world is moving toward digital assets tokenized on the blockchain, and Ethereum is completely dominating this narrative. There are huge players like BlackRock already building on Ethereum. They're putting trillions of dollars of real-world assets on chain. So when I provide ETH USDC and my position gets converted to ETH, I'm completely fine with that. I'm more than happy to HODL ETH. If my position gets converted to USDC, well, that's a stable coin, so I'm fine with that as well. No matter what happens in my position, I'm comfortable either way. The other big reason is the volume. ETH is one of the most actively traded assets in all of DeFi. Traders are swapping ETH around the clock, every hour, every day, and every one of those swaps generates a fee for the liquidity providers. That's where our steady cash flow comes from. It's not from token emissions. It's not farming rewards. Our yields come from real trading volume. That's the key difference and why this works so well. At this point, you're probably thinking, this sounds great, but how do I actually know where to put my price range? Think of it like this. Your job as a liquidity provider is to capture price action. It's like you're fishing and you're trying to figure out where to throw your net. You want to catch as much of the future price action as possible. Now, keep in mind, you don't have to make a perfect prediction of the future. You don't have to hit a bullseye here. It's more like you're hitting the side of a barn. So let's start with an ETH chart on TradingView, and I've set this to a 1 hour time frame, which just means each candle represents 1 hour of trading. With this chart in front of us, we're just going to do some really basic technical analysis. I'm just looking at the last 3 or 4 weeks and finding the pivot points. A pivot point is where the price reversed. For example, right here, the price stopped going down. It pivoted and started going back up. That's a pivot point. Right here, just recently, price stopped going up and reversed back down. That's another pivot. Now, I do have a bit of a recency bias with these pivots. The more recent pivots are more important. I'm going to pay more attention to those. What's also important is if there's a certain level where price has pivoted more than once. For example, if we look at this 1900 level, we can see the price turned higher several times. That's clearly a support level. Another interesting level is right here around 2200 where we had this double top. After the double top, ETH tried to break out higher, but it ended up being a failed breakout. Now that it's back below, 2200 should be a pretty strong resistance level. So as I'm thinking about the next several days and what the price is likely to do, I'm looking at those pivots as levels where the price will probably reverse in the future. This is where I want my net between 1900 support and 2200 resistance because I believe the price is likely to stay within that range. So far, we've selected our pair, ETH USDC, and we've settled on our price range from 1900 up to 2200. Now, this next part is crucial, but it's actually something most people skip, even experienced liquidity providers. See, the same ETH USDC pair exists on multiple networks, different exchanges, and with different fee tiers. They all pay different yields. So we have to compare these different pools and figure out which one pays the best. The tool I use for this is Krystal. Let me show you how I do it. All right, so this is the Krystal website, and I'm gonna start out by going to Hot Pools, and this is showing basically every liquidity pool under the sun. I'm gonna narrow this down by network. I'm going to look at only the Ethereum network plus Base and Arbitrum. Next, I'm going to filter out all the different exchanges except for Uniswap V3. I like to use Uniswap V3 because that is the only one that's compatible with Revert Finance. And I'm a big fan of Revert Finance. I do like to apply some leverage to my liquidity positions once in a while. Now, as far as the tokens, we're going to provide ETH USDC. When you put ETH into a liquidity pool, into a smart contract, it has to be the token form of ETH, and that is called wrapped ETH. So I'll just type in WETH. That stands for wrapped ETH /USDC. So what Krystal does is it looks at 3 different factors and then it computes the yield for each one of these liquidity pools. So the first factor is the fee tier. This is the swap fee that traders pay to liquidity providers for every swap. So obviously the higher the fee, the higher the yield. Next, Krystal looks at the volume. Here it's showing the volume over the last 24 hours. And again, higher volume equals more yield for liquidity providers. And the third factor that Krystal looks at is the TVL. So that stands for total value locked. And that just means with more TVL, with more liquidity in the pool, we're having to share the fees amongst more liquidity providers. So actually higher TVL means lower yield for each individual liquidity provider because you're having to share the fees with more providers. So Krystal is going to look at all 3 of those factors. And then for the volume, I'm going to drop this down and I'm going to look at the 7-day APR. Then I'll click this button here to sort it by the top performing. Now it's looking at the yield earned by the entire pool in the course of 1 year. So that's the annual percentage rate earned by the entire pool, regardless of range. And this is based on the last 7 days of volume. So the highest pool is this 0.3% fee tier on Uniswap on base. I'll also take a look at the 30-day APR. So again, Krystal is computing the annual yield earned by the pool based on the last 30 days of volume. So I like to look at the 7-day and the 30-day APR. I don't really care about the yield based on the last 24 hours. I want to look longer term than that. So in both cases, the 7-day and the 30-day, it looks like this pool is earning the highest yield or has been earning the highest yield. So this is the liquidity pool I'm going to select for my position. All right, you've got your pair, your pool, and your price range. We're going to stay on Krystal for one more thing, and then we'll head over to Uniswap and open the position. I'm going to use Krystal to simulate the liquidity position that I'm about to open. So I'm going to click into this pool that we've selected, the 0.3% fee tier. Then I'm going to enter the range that we decided. So we're going to go from 1900 up to 2200. Next, I'm just going to tell it how much money I want to put into my position. And then this simulator here will figure out what I need in terms of wrapped ETH and USDC. The way that works is if we have our range set up from 1900 up to 2200, actually 2195, you can see that this upper portion is smaller and this lower portion is much larger. So if traders start to buy and the price starts to go up, this part of our position needs to be stocked with wrapped ETH. So that's our ETH shelf. If traders start selling ETH, our position needs USDC to buy ETH from the traders. So this larger portion, that's our USDC shelf, and that's what we need to be stocked with USDC inside of our position. What Krystal is doing is it's doing that math for us. If I want to open up a $100 position, I'll need about $17.50 of wrapped ETH, and I'll need about $82.50 of USDC. So now I'm on the Uniswap page here, uniswap.org, and I'm going to go to this pool menu and create a position. I would like to create a V3 position, and now I need to select the 2 tokens. So the first token is going to be wrapped ETH. So I'll click on this drop-down menu. I want you to pay attention to this little drop-down menu right here. Uniswap exists on many different blockchains, so I need to choose the base blockchain from this menu. So there it is right there. And then here is my wrapped ETH token. If you didn't see that, you could search for WETH, but there it is right there. So that's the first of my 2 tokens. The next one, of course, is USDC. There it is right there, staying on the base network. Now, this has already defaulted to the 0.3% fee tier. Remember, that was the top performer back here on Krystal. The 0.3% fee tier is the one that came out on top. If something else came out here, I would just click on this menu and then choose the top performing fee tier for your position. Hit continue. Now on this, I'm going to do a custom range. I'll go ahead and set up the range that I decided on already, 1900 and 2195. Now it doesn't have to be perfect, but if I want to deposit exactly $100, I'll go ahead and put my range back in here on the simulator, tell it that I'd like to deposit $100. It's going to tell me exactly how much USDC and the wrapped ETH. So I'm just going to type in $82.46 in the USDC box here. And Uniswap is going to match that USDC deposit with the appropriate amount of wrapped ETH. This balance will change around because this is an active market. The price is moving. And so whenever the price moves up, it's going to need less ETH and more USDC. If the price moves down, it'll need more wrapped ETH and less USDC. But that looks good. I'll go ahead and review and create the position. Now, these are the token approvals. I have to sign these permission slips on the blockchain so that Uniswap can take these tokens out of my wallet. It always defaults to an unlimited token approval. So what I just did there is selected my wallet balance. I'll go ahead and sign the transaction. All right, so wrapped ETH is approved. The other token I need to approve is the USDC token. So again, this is like a permission slip. You're giving the Uniswap smart contract permission to take these tokens out of your wallet. Like I said, the default is usually an unlimited token approval. We don't want that. I'm just going to click my wallet balance here so that it only has permission for 86 tokens. Sign the transaction. The final transaction is here. This is where I'm sending USDC and wrapped ETH to the Uniswap contract. And Uniswap is actually going to mint a NFT. This is a unique non-fungible token coming back out to my wallet that represents my liquidity position. That's sort of a proof of ownership for the position. This is what allows me to collect the fees and later on to withdraw the liquidity back out of the pool. So I'll sign this final transaction. And the position was created. Now it goes back to the dashboard here and we can see my position right here. If I click into it, we can see the current balance of the position. Obviously, I just started it, so no fees have been earned yet, but this is where you would come back the next day and see how much you earned on a $100 deposit or whatever you deposited. From the moment you open a liquidity position, every time a trader swaps ETH in your price range, you earn a portion of the fee. The fees automatically accumulate on Uniswap, but they're held separately from your position. You can collect them whenever you want. And when you do, your liquidity position stays put. It keeps on earning as long as price is in range. Now, if you're watching this and thinking, I want to do this, but I don't want to figure it out alone, that's exactly why we built the Accelerator. In 90 days, you'll go from watching videos like this to running your own positions and earning daily fees. We handle everything with you: the wallets, the security, the lending, the pools, and the management. You skip the months of trial and error, you skip the costly mistakes, and by day 90, you're operating independently, confidently, and profitably. If that sounds like what you need, book a free strategy call. Links in the description. No sales pitch, just a conversation about your situation. Providing liquidity is one of the most powerful ways to earn high yields in our DeFi carry trade. Again, borrow low, usually around 5% on Aave, and earn high, anywhere from 60 to 120% on Uniswap. You profit from the spread. You're earning fees from real market activity happening right now on chain every day. Remember guys, this video is for educational purposes only. DeFi protocols involve smart contract risk, impermanent loss, and market volatility. Past yield is not indicative of future performance. Always do your own research before deploying capital. Nothing in this video is financial advice. Speaking of market volatility, we also have a video on how to eliminate your downside risk with hedging. Link in the description. If this has been helpful, give us a like, subscribe to the channel, drop your questions and your yields in the comments below. Thanks for watching. I'll see you guys next time.